What if I told you the entire financial system is built with recurring breaking points? Not just once, but as a feature of its design. Right now, global debt has reached $315 trillion, according to World Bank data. That's nearly 3 times the world's annual GDP of around $109 trillion, and a level not seen since the Napoleonic Wars. Historically, debt only reached these heights during major global conflicts. But this isn't just about numbers on a page. It's about a system where central banks are trapped, markets rely on cheap money, and even small shocks can trigger outsized collapses. To understand why the next crisis is a question of when, not if, you first need to see how this debt burden affects every person on the planet. Consider what it means that each person's share of global debt is roughly $39,000. This number isn't just a theoretical calculation. It represents the financial obligations that accumulate through governments, corporations, and households worldwide. If you break down the $315 trillion total, about $59.1 trillion comes from household borrowing, $164.5 trillion from businesses, and $91.4 trillion from government spending. Most people never see this figure on a personal statement, but the reality is that these obligations shape the economy you participate in every day. The consequences become clear when you look at countries like Zambia. In 2021, debt servicing consumed 39% of Zambia's national budget, more than what the country spent on education and healthcare combined. This isn't an isolated case. Japan's total debt exceeds 600% of GDP, with public debt near 260%. The United States recently surpassed a 120% debt-to-GDP ratio. Across emerging markets, debt accumulation has reached record highs. According to IMF data, 60% of low-income nations are now in or near debt distress, a figure that's doubled over the past decade. What sets the current environment apart are 2 unprecedented factors. First, the scale. Global debt has increased by $100 trillion in just the last 10 years. Second, the timing. A massive refinancing wall is approaching. The Institute of International Finance reports that over $3 trillion in corporate debt will mature in 2024, much of it borrowed at ultra-low interest rates before 2022. Most countries are now allocating between 10% and 25% of their revenue simply to pay interest on existing debt. This creates a situation where even modest increases in interest rates, like those seen in 2022 and 2023, can rapidly escalate debt servicing costs. The UK's brief crisis under Liz Truss, where a minor tax proposal triggered pension fund liquidations and a bond market shock, demonstrates how fragile the system has become. The problem wasn't the policy itself, but the inability of financial markets to absorb changes after years of easy money. Historically, after World War II, debt-to-GDP ratios spiked but then declined as economies grew and populations expanded. Today, the opposite is happening. Aging populations and slow productivity mean that credit is growing 3 times faster than economic output. This divergence leaves central banks facing a dilemma. Growth now depends on ever-increasing debt, but more debt makes the system more unstable. Unlike past crises that were concentrated in either government, corporate, or household debt, today's burden is layered across all 3. This overlap creates multiple points of vulnerability, especially as interest rates shift. The pressure on central banks to manage these conflicting demands is reaching a breaking point. Central banks now face a dilemma that research shows is built into the system. Raising interest rates to control inflation increases the burden of existing debt, while keeping rates low encourages further borrowing and risks fueling inflation. The result is a cycle where each policy response trades one risk for another, and the system never truly stabilizes. The events of 2022 in the UK made this clear. When the Bank of England raised rates to fight inflation, a seemingly minor government tax cut announcement triggered a wave of margin calls on pension fund derivative positions worth £1.5 trillion. Within days, the funds faced forced liquidation. The Bank of England intervened with an emergency purchase of £65 billion in government bonds, reversing its previous policy of quantitative tightening. This was not a shift in monetary policy. It was a tactical move to prevent a pension system collapse that could have become a Lehman-type event. The episode highlighted how actions meant to restore price stability can instead threaten the financial system's core. Quantitative tightening adds another layer. Since 2022, the Federal Reserve has reduced its balance sheet by about $1.5 trillion while raising rates. This simultaneous tightening has strained both the banking system and the Treasury market. According to BIS research, the depth of trading in U.S. Treasuries is now as thin as it was during the market turmoil of March 2020. The IMF has warned that this combination of shrinking liquidity and rising rates could trigger dysfunction in the world's most important debt market. When major central banks move in different directions, like the ECB holding rates steady while the Fed tightens, currency swings and capital flows create new stresses, especially in emerging markets. To prepare for possible disruptions, 14 central banks have arranged swap line capacities totaling $1.9 trillion, an emergency backstop in case the Federal Reserve withdraws global dollar liquidity. These defensive measures underscore how interconnected and fragile the system has become. The doom loop is the pattern that emerges. Every major crisis response, like the 2008 bailouts or 2020's quantitative easing, fed more debt into the system, reducing the options available for future policy. Each intervention plants the seeds for the next round of instability. Central bank balance sheets have grown from $5 trillion before 2008 to more than $25 trillion today. Interest rate changes that once unfolded over years now happen in months, overwhelming risk models and exposing the limits of institutional hedging strategies. The underlying flaw is clear. Debt needs growth, growth needs more debt, and sustaining both demands ever easier monetary conditions. Central banks have become the enforcers of this cycle, using their tools to keep the system running rather than to restore real balance. Each round of intervention leaves the financial system more leveraged and more dependent on emergency support. Yet the most acute risks are no longer where regulators expect. The next vulnerabilities are building in places that aren't visible on central bank balance sheets. Since 2008, shadow banking assets rose to about $239 trillion, according to BIS data. This sector, pension funds, hedge funds, investment funds, and other non-bank lenders, has grown as tighter bank regulation pushed more credit activity into less regulated territory. Non-bank credit now stands at 260% of global GDP, a scale that highlights just how much risk has shifted to these opaque corners of finance. Hedge funds show how leverage amplifies fragility in this sector. Many funds now operate at leverage ratios exceeding 40-1. At that level, a market move of just 2.5% can erase their capital. B of A's High Yield Index shows CCC credit spreads near 928 basis points, the highest since September, one signal that these highly leveraged players are under stress. The IMF warns that this kind of leverage imperils market functioning during periods of volatility. Recent bond market swings forced some funds to liquidate positions rapidly, amplifying price declines and transmitting risk throughout the system. Unlike banks, these funds face no capital requirements or stress testing, yet their activities have the power to destabilize entire markets. Pension funds add another layer of vulnerability, especially when liquidity mismatches emerge. Many promise daily withdrawals while holding illiquid assets such as private equity or infrastructure. When gilt yields spiked in the UK in 2022, thousands of pension schemes using liability-driven investment strategies ran margin calls, exposing the fragility of these structures. Forced selling in illiquid markets created downward spirals, and the knock-on effects quickly spread to other financial institutions. The IMF notes that the deepening nexus between traditional banks and shadow lenders means that distress in one segment can rapidly cascade across the system. The repo market, central to short-term funding, has also shown signs of stress. In September 2019, overnight repo rates spiked unexpectedly, prompting the Federal Reserve to inject $75 billion to stabilize the market. These sudden disruptions underscore how the rise of shadow banking has increased the system's overall fragility. While traditional banks have become safer, risk has simply migrated to areas with less oversight and fewer safeguards. Shadow banks now account for nearly half of all global financial assets. They provide credit, much like traditional banks, but without deposit insurance or central bank backstops. When problems arise, there's no established playbook for containment. The warning signs, excessive leverage, complex interconnections, liquidity illusions, mirror those seen before 2008. But today's scale and opacity make the risks potentially greater. Central banks have less room to cut rates, and regulators still lack visibility into most shadow sector activities. With credit markets increasingly shaped by these unseen forces, the signals from junk bonds and high-yield credit are becoming harder to ignore. Credit markets act as early warning systems for the broader economy, with high-yield bonds often providing the first signals of stress. In mid-April 2025, the ICE B of A High-Yield Master 2 Index Option Adjusted Spread rose to 355 basis points, matching its peak from August 2024, according to research. Just 2 months earlier, spreads were as low as 262 basis points, a level comparable to May and June 2007, just before the global financial crisis began. This rapid widening signals increasing investor concern about the ability of lower-rated companies to service their debt. The services sector is also flashing caution. The average of the 5 regional Federal Reserve Services PMIs fell to negative 17.5, the lowest since December 2022, based on Dallas Fed data. Since services make up more than 70% of U.S. GDP, this contraction points to weakening demand across a critical part of the economy. Historically, deteriorating service activity has been a reliable precursor to a rise in corporate defaults, often with a 6-month lag. Moody's projects that the global default rate may climb from 1.5% to 3% by the end of the year, according to recent research. Companies that borrowed heavily during the era of ultra-low rates, especially in sectors like retail, healthcare, and telecom, now face shrinking revenues, higher input costs, and rising interest expenses. Many of the weakest firms used floating rate debt, which exposes them even more as rates rise. The result is a 58% year-over-year surge in distressed debt exchanges, a sign that financial pressure is intensifying. Institutional investors are responding with a clear flight to safety. In mid-April 2025, the U.S. 2-year Treasury yield fell to 3.84%, its lowest since October, as investors moved out of riskier assets. This part of the yield curve is closely watched because it reflects both Federal Reserve policy and market expectations for growth. The decline suggests a growing consensus that economic conditions are deteriorating and that central banks may be forced to reconsider their tightening stance. The risk is not just in rising defaults, but in the collateral chains built on junk-rated debt. When credit quality drops, pension funds, insurance companies, and other institutions may be forced into mandatory selling, which can trigger a feedback loop of price declines and further selling. Recent bank failures have shown how quickly liquidity can dry up when multiple institutions offload similar assets at once. This situation is not a black swan, an unforeseeable event, but a gray swan, a risk hiding in plain sight. Bloomberg and the Financial Times have both described junk credit as the biggest financial threat, echoing the gray swan label found in the research. The warning signs, widening credit spreads, weak PMI data, rising defaults have accumulated for months, yet market behavior often ignores them until they become impossible to overlook. This complacency is partly driven by years of central bank intervention, which has conditioned investors to expect rescue at the first sign of trouble. The risk now is that several stress factors converge: high leverage, tighter credit, declining earnings, and rising refinancing costs, all while central banks remain constrained by inflation. Unlike past cycles, the system now carries much higher debt relative to GDP and has less room for policy maneuvering. Credit markets are pricing in these realities well before official data or recession calls arrive. Ignoring these signals, assuming they're temporary or contained, repeats the error of 2007, when gradual deterioration was dismissed until it became a systemic crisis. The vulnerabilities that surface here don't remain isolated. They ripple outward, exposing the hidden fragilities that come from the global financial system structure. One of the most overlooked vulnerabilities in the financial system is the dominance of the US dollar. The world relies on the dollar not only for trade and reserves, but also for servicing a massive amount of debt. This system, often described as Bretton Woods II, was shaped by the recycling of export surpluses, especially from Asia, back into US Treasuries, as noted by Bernanke in the early 2000s. The arrangement provided stability for years, but it also concentrated risk. When global trade slows or tensions rise, the flow of dollars can quickly become disrupted. Recent trade wars highlighted how fragile this structure is. After the US imposed tariffs, capital fled emerging markets, and investors sought safety in dollars. The IMF specifically warned about the sharp repricing of risk assets that followed these announcements, with protectionism tightening financial conditions worldwide. For countries that run trade surpluses, shrinking reserves come at the worst time, just as their dollar-denominated debts need to be serviced. The scale of this vulnerability is significant. Emerging economies now hold $105 trillion in total debt, equal to 257% of their combined GDP, with a substantial portion coming due in dollars. Unlike the US, these countries cannot print dollars to meet obligations. When dollar liquidity dries up, as it did during the 2013 taper tantrum, refinancing becomes nearly impossible without resorting to harsh austerity or turning to the IMF for help. This risk is amplified as the Federal Reserve reduces its balance sheet, pulling dollar liquidity out of global markets. To manage these pressures, the Federal Reserve maintains a network of 14 swap line relationships with major central banks. These swap lines act as emergency channels, providing foreign central banks with access to dollars when market stress peaks. The Fed used these tools aggressively in the fourth quarter of 2008, supplying $583 billion in swaps, and again in March 2020, extending $450 billion to stabilize markets. During the March 2020 dash for cash, the Fed's T-bill reverse repo facility briefly hit $1 trillion as investors dumped assets in favor of cash, underscoring the system's dependence on reliable dollar access. Yet, this reliance introduces a structural flaw. The dollar accounts for 58% of global reserves, but the Federal Reserve's mandate is domestic. When the Fed tightens policy to fight US inflation, the rest of the world can face collateral damage. Emerging markets are often forced to raise their own rates just to defend their currencies, even when their economies are already under strain. As global trade fragments and more countries settle transactions in alternative currencies, the traditional recycling of dollars into US debt weakens. This may shrink the pool of buyers for treasuries and push up US borrowing costs, adding another layer of instability to a system already stretched by high debt levels. All of this creates an environment where dollar strength becomes a risk in itself. As the dollar rises, the cost of servicing global debt climbs, increasing the likelihood of distress and amplifying the need for dollar liquidity that may not always be available. The system's stability now hinges on the continuous, predictable functioning of these dollar backstops. This dynamic doesn't just shape the fate of nations and institutions. It reaches into the personal finances of anyone holding cash, debt, or assets exposed to global shocks. Everyday financial decisions play out against a backdrop of systemic fragility. Inflation quietly erodes the value of cash savings. At a 5% annual rate, money loses half its purchasing power in 14 years, according to the OECD CPI data. Since 2020, US consumer prices have climbed nearly 20%. This environment rewards asset holders and penalizes savers, as inflation reduces the real burden of debt while diminishing the value of idle cash. Asset price swings present another challenge. During the February-March 2020 crash, the S&P 500 fell 33.8% in just over 3 weeks, as documented in market research. In 2022, even bonds, traditionally considered a stable part of a portfolio, suffered, with the U.S. aggregate bond index dropping 13.4%, its worst performance in centuries. These episodes are not rare anomalies. They reflect how quickly liquidity can evaporate and how easily forced selling can occur when investors face margin calls or redemption requests at the worst possible moment. Traditional portfolio strategies have struggled in this environment. The classic 60-40 stock-bond mix failed in 2022, with Bloomberg indices showing stocks down 30% and bonds down 9%, a rare simultaneous decline. Effective diversification now means seeking assets that do not move in lockstep with mainstream markets. For example, after Japan's banking crisis in 1998, investors who shifted to gold and commodities found better hedges against domestic market weakness. The lesson is to build portfolios that can withstand multiple scenarios, rather than trying to predict the next shock. Liquidity management has become more sophisticated. The tiered reserves approach, seen in pension fund strategies after the UK's LDI fallout, involves holding immediate cash, short-term government securities, and assets that can be liquidated in stages. This structure helps avoid forced sales during downturns and keeps options open when markets are stressed. Crisis planning is no longer optional. Stress testing your finances using scenario analysis similar to the BIS-QIS 2023 bilateral network models means asking, what if your income drops suddenly? What if markets fall and take years to recover? What if inflation remains high for a decade? Each scenario requires specific defenses: larger emergency funds, staggered bond maturities, or allocations to assets that benefit from inflation. Understanding the system's fragility changes how you approach risk. You become more skeptical of long-term debt in a rising rate world. You question products that promise steady returns in volatile conditions. And you recognize that mainstream advice often comes too late. By the time the consensus shifts, the window for action has usually closed. The web of global finance means your security is tied to forces beyond your control. A default or shock in one market can ripple through portfolios worldwide, affecting even the most cautious investors. Preparation, not prediction, is what builds resilience. It's about reducing dependence on any single institution, diversifying across assets and accounts, and routinely stress testing your financial decisions against the possibility of systemic shocks. This approach doesn't guarantee safety, but it does provide a framework for navigating a system that prioritizes its own stability over yours. The financial system isn't failing, it's functioning as designed. Research shows central banks' policies perpetuate fragility, not resilience. True stability starts with recognizing the inherent instability, debt traps, liquidity mismatches, and policy dilemmas that create recurring crises. Now you know why debt, central bank traps, and shadow banking form a cycle of instability. The key defense is building portfolios aligned with these systemic risk realities, using negatively correlated assets, tiered liquidity, and regular stress tests. Instead of relying on outdated assumptions, adapt to the system's vulnerabilities with practical, informed strategies. If this analysis helped you, hit like and subscribe for more insights.